Hi, Vote. Hi, Bobo Hero. Hi, Israel. How you all doing?
Doing fine.
Good evening, sir.
Good evening. Hope you all have had an incredible weekend.
Yeah, yeah.
Yes. Yes, sir.
Awesome. Cool, cool. So did any of you go through the videos I outlined on the general group? Those videos I told you to have a look at on YouTube. Did anybody go through those videos?
Yeah, today I was watching some of your old videos on Euro USD on YouTube. Yeah, and if you, I even went to my chat and backtested like where you were talking, what you were saying then before the price worked out, and I was like, yeah, it works. Like it went directly where you had said it will go before even seeing the price. So, yep.
Yeah. So you can basically see how both DXY, even S&P 500 and Ethereum. So many of them, even Binance. Binance is currently at 1,000. If you go through my videos, I can't remember which one it is, but one of the videos I also talked about Binance hitting 1,000 and above. Back then, I think it was around 200 or something. So
Mhm.
that's why I said when you go through those videos, you'll see that that's literally a full-blown course on its own that will teach you so many things, and it's all free value right there for you. And every day I'm still dropping so much more in there. So all you got to do is just follow the page, follow the subscribe to my channel and turn on the notification bell. So anytime I drop any video there, you get notifications and you can just go through those videos. You always get insights. Like even votes, a lot of the times he will message me asking me questions relating to videos I posted on Instagram,
Yeah.
because he spends time watching those videos and votes. Would you say that those videos give you like, do you get any sort of value from those videos?
Yeah. Actually, it's a lot. It's like I'm in the mentorship and I'm not. It is like I'm in and I'm not.
Awesome.
So they are very informative.
Yeah. So the main thing is for you to know how to use those informations because if you're an absolute beginner, you have zero experience. Some of those things might sound a little bit complex. But if you have some level of experience, maybe you've gone through my course or you've gone through any of my mentorship programs, maybe the group mentorship program or the one-on-one, it becomes so much easy when you see those videos. You will see the price actions I'm talking about, the key levels I'm talking about, and I'm posting them before the price action happens. I'm not the type of person to post after it has happened. I'm showing you what I'm watching, what I'll be looking at, what I'll be trading. And if you're following those price action, you see how they will still follow the market structure. That is why market structure is always the number one thing as a trader that you need to understand. There's probably nothing wrong with your strategy. It's just you not understanding market structure. I can recall like,
Actually,
yeah, you want to say something?
yeah, I was trying to say if you join the mentorship, then you move on to the videos. It's like everything is just clear to you now. Because you'll get to ask questions, you'll get to understand it better. So when I look at the video, it's like, I'm getting things faster.
Yeah, absolutely. Absolutely. Like I was talking to someone in my one-on-one program the other day, and I was talking about a strategy that I was using in my first year as a trader. I was trading with the MACD strategy. I was trading with MACD. So I don't know if you guys know what is MACD indicator. Does anyone here know what is
Yes, sir. I used.
you use MACD?
Yes, sir.
Cool. Now,
Yes, sir.
when I was using MACD, I was making money. I was flipping an account. Literally flipped the account from 200 to 1,000 to 2,000. And this is literally within a few days. And then I just got overconfident and I started trading aggressively and I blew that account. The reason I blew that account wasn't because the MACD strategy wasn't working. It was simply because I didn't know when to stop. I didn't have a structure to use That's MACD strategy. This is why I said in the first session we started with this program. I said that most strategies are a lot of strategies out there, they do work. Trend line works, support resistance work, MACD works, EMAs work. The problem with traders is they don't understand market structure in order to use that, align it, and take their trades. They don't understand it. What I was doing when I was using the MACD strategy, this is what I was doing back then. Now, so so what I was doing back then was, now if I look at a chart and I see that that asset or whatever pair that is, I can see that is bullish. What I'll do is I'll be looking at this MACD strategy, and then the moment I see this big one, and then I see the next one, the moment I see this big one, the next thing I'm doing is I'm looking for opportunity to buy this. The next thing I'm waiting is to see this cross. Once I see this cross, I'm looking for a buy. I'm using the nearest low as my stop loss. And look at this. This is an example. That means in this situation, I would have bought here and my stop loss would be here. And can you see that that would have been a profitable trade? And the same thing right here. The same thing. Once I see this red, the last red one looking very big, the next thing I'm waiting is to see that cross. Once I see this cross, I'm looking for a buy, and I'm using the latest low as my stop loss. And this would have been my stop loss. Entry would have been around here. And that would have still been a profitable trade. And the reason I'm showing you this is I do not trade indicators, but these indicators do work. The only thing that will make your strategy to work for you is your understanding of market structure. Whether you're trading with trend lines or you're trading with indicators or you're trading with support, resistance, whatever it is, the moment you understand market structure, you will see that everything else will align with it. So I'm not trying to come here and sell you a dream and tell you that my strategy is the number one strategy in the world and it's better than everything else. That is not what I'm here to tell you. What I'm here to tell you is that you should focus first on that foundation. Understand market structure. Anything else you want to do, any other strategy you want to use, you will see that everything else will start to work. You will have wins, you have losses. But as long as you understand that foundation, everything else will start to work out. Does that make sense, everyone?
Yeah.
Awesome. So now,
Market structure is the skeleton of everything.
absolutely. So now for our topic today, which is understanding how to use the Fibonacci and how to align the Fibonacci with market structure and efficiency. I'll show you multiple examples going from the higher time frame, and then we'll scale down to the lower time frame. And we're going to start with Forex. We're going to start with DXY. So right here, we can see this is dollar. And if we go to 12-month time frame, you can basically see that the dollar market structure bearish, consistently creating lower highs and lower lows. And you can see that right here. You can see right here where we're creating lower highs and lower lows. This is the lower high, and then this is a lower low here. And then we'll have this lower high, and then this lower low right here. Now, this is the Fibonacci. The next thing I'll do is I'll draw my Fibonacci from the overall high to the overall low. And right here, this is my overall high, this is my overall low. I draw the Fibonacci from the high to the low. And right here, this is my equilibrium. And then, yeah. And right here, this is my extreme premium. And here is my extreme discounts. Then bear in mind that anything above equilibrium is premium. And anything below equilibrium is discounts. Now, what does this even mean? What this simply means is if the market structure is bearish, what I'm looking for, what I'm interested in is sells on premium and continuation to the downside. So if price should come into the premium level above equilibrium, my interest would be to sell. Now, in this case, you can see that price came to the upside very close to the equilibrium because we have this inefficiency here that acted as resistance and it sent price straight to the downside. And after that, we created a new low. Now, what do? I take my Fibonacci from this new high to this new low right here. Now you can see in this case, price rallied to the upside, went to an extreme premium, and after that would displace to the downside. And right here is our equilibrium. What does this mean? This simply means that sales are high probability. There's a very high chance that if you're looking for sell opportunities while we're inside this premium zone, those sales will have a high chance of going in your favor. Now, this doesn't mean that you should just randomly jump into the chart and just start selling from random areas. This is now when you use market structure on the lower time frame, whether it's 4-hour time frame, daily time frame, align that with the inefficiency, using that as your point of interest. When price comes into those positions, you're looking for sales inside premium. Let me show you what that looks like. Example, we go to monthly. Now on the monthly time frame, what can you see here on the monthly time frame? You can see that right here is extreme premium, and look at what's resting right here at the extreme premium, inefficiency. So now we're using this inefficiency as a point of interest. Price coming up there, we're using that inefficiency as point of interest. We look for sell opportunities. We can simply, this is the monthly. So if price comes into this position and we see a 4-hour break of structure to the downside, we'll start looking for sell opportunities. So let's go to the 4-hour time frame and see what that looks like at this key level. Now, if we go to 4-hour time frame, this is 4-hour time frame. Now, on the 4-hour time frame, all we want to see from that position is a 4-hour break of structure to the downside. And right here, let's look at that. This is the extreme premium. Right here, you can see the extreme premium. So we look for the 4-hour break of structure to the downside. And right here, you can see how price was going to the upside, creating higher highs and higher lows. Right here, you can see we created a higher low, and then we created a higher high, and then we created this higher low, and then eventually a higher high, and then we'll have a break of structure down here. The moment you see this break of structure, this entire zone becomes our distribution zone and also a high resistance liquidity zone. What does a high resistance liquidity zone mean, and what does a distribution zone mean? This simply means this is an area where we will be looking for sell opportunities, a high probability area that whenever we see price mitigating that position, we are looking for sell opportunities. And look at how many times price tapped into that position and give you sell opportunity. The first time it tapped here, you can use this inefficiency as your confluence and distribution zone as well. Look for sell opportunities, and you can use an inefficiency as a take profit position. And look what happened. It came right down into another inefficiency, which you could have used as your take profit right here. The moment it hit that level, you get money, you get out. Price rallied again to the upside, came into the inefficiency, played around, rallied again, took liquidity, still inside the inefficiency. And what did it do again? It went straight to the downside. And what did it go down to mitigate? It went down here, took liquidity, and you'll be surprised that if you go to a higher time frame, you will see that there's actually a very small inefficiency here. Let me mark that out so you can see as well. So right here, you can see there's this very small inefficiency. Let me zoom in so you can see what I'm saying. And you can see right there's an inefficiency. And that could have been your take profit position. Price hitting that level, you're taking what you've made, you're getting out. Price rallied again, same area of distribution, the high resistance liquidity zone. What makes it a high resistance liquidity zone is because there's already an external range run on liquidity from here. And after that run on liquidity, there's a break of structure showing the intention that price wants to now go from going bullish to bearish. And right here, this is another time price mitigated that position. And after that, what happened? You can see we now went straight for a free fall. Let's go to 1-day time frame to see what that looks like as well. And on the 1-day time frame, you can see that this was the last time we tapped that position. Several times price tapped into that position. It's always rejected off that key level before we dropped out and went straight to the downside. So let's go to the weekly as well. And on the weekly time frame, I'm just going to take this out. So if you watched that video, if you watched if you went through the write-up I posted in the general group where I was talking about my analysis that I posted like almost 3 years ago about DXY. DXY was literally around here in that analysis. And I was saying that DXY is literally going to go to the downside. It was literally around 104 in that video. And 104 is right here. And I said DXY is literally going to go to the downside. And since then, almost 3 years ago, DXY has been in a downtrend. This is just clean understanding of market structure. There's no rocket science about it. There's nothing fantastic about it. It's just you understanding market structure. Once you see the market structure shift on the higher time frame, just follow the trend. Don't try to go against it. Don't try to focus too much on what the news is telling you. They're telling you there's going to be a recession, so dollar is going to be the recession proof. A lot of the times that is all manipulation to push you to go towards one direction so you can get wiped out. Listen to this. If everyone in the world becomes rich, who's going to be the doctor? Who's going to be the nurse? Don't you see that for the system to work, there needs to be a 1% that is rich, and then maybe 20% average, and then the rest 70% broke? Because that's how the system works. Because if you're rich, you're not going to be satisfied with someone paying you 10 pounds per hour to do a job. Imagine telling Jeff Bezos to come work for you so you can pay him 20 pounds per hour. How's that going to turn out? So that is to show you that the system was designed for most people to be on that broke level. That is why most times when I see people, they read the news and they try to make investment decisions based off news they saw on maybe CNN, BBC, Sky Fox, or whatever. Most of the time, they end up losing their money. So back to our analysis. So you can basically see right here, we'll have a significant weekly break of structure. So the only thing we'll anticipate to see is for a retest. And that retest could be on either this last up close candle or inefficiency, most likely. That's what I'll prefer to use, inefficiency. And if price should mitigate the inefficiency, that would be a perfect area for a continuation sells. And right here, this is the inefficiency. Now, if this was a trade that I was trying to take, that's how I'll play it. That's what I'll be looking at. And why would I focus more on this inefficiency? Because there's liquidity here. Low resistance liquidity. Why is this a low resistance liquidity? Because there was no external run on liquidity. None of this, if this had taken liquidity from here, then I would have said, okay, that would have been my point of interest. But because there was no external run on liquidity, here becomes low resistance and price can easily run that high. And then after that, we could now see a reversal for a continuation to the downside. So let's go to continuation of using the Fibonacci, and we go to the monthly. Does anyone have any questions? Everything I'm saying, does it make sense? If you have any question, feel free to ask a question.
How do you, if you notice like there's this fair value gap up there and price seems to like ignore it first before it moves, before it goes for it, how do you move around the market, like knowing that it might come there?
Now, if there's an inefficiency, a fair value gap that I've marked out and I'm waiting for price to mitigate it and take a trade, and it fails to mitigate that position, what I do is I wait for a higher time frame break of structure, like 4-hour, daily. If I see a daily or a 4-hour break of structure and it broke significantly, that could be giving me a telltale sign that price actually doesn't want to mitigate that zone yet. And that's something it wants to leave for later. So I'll show you an example, maybe probably a few examples, because I've seen that happen quite often. For some reason, I don't know why my chart is not opening up. So let me just close it, a different one. So So right here, let's go to Forex. Yeah, so back to that analysis that we were doing on DXY. Can you see what happened right here? Can you see the
Yeah.
price came up there, took all that liquidity, and then displaced to the downside? Now, this is not rocket science.
After a year.
Can you say that again? Sorry.
After a year, like, yeah, it remembered.
Yes.
I think.
Now, always remember this, the algorithm doesn't forget. We traders are the ones that do forget. The algorithm remembers that there's an inefficiency at a certain key level, and it's always going to come back to revisit those key levels if it wants to. Now, back to your question, Vo, to answer your question. Now, right here, this was a typical example because this was, I think it was 2022. Yeah, 2023. I was anticipating for price to come down into this inefficiency. I wanted to buy from that inefficiency in 2023. Right here was the inefficiency. And then I already marked it out and I was waiting patiently for price to come in there. And then unfortunately, price came very close and then it reversed. Now, when it reversed to the upside, this was a very tricky price action. Now, what did I do? Did I rush in and start trying to sell into that inefficiency? No, because that would be me going against the trend. What I did was I literally simply waited for a higher time frame break of structure. So let's go to that price action.
That's what I was watching today.
Now, I literally waited for a higher time frame break of structure. So it's either I'm using a 4-hour or a daily break of structure. Most preferably, I would prefer using a daily break of structure. That is just me personally. I'll prefer using a daily break of structure rather than 4-hour. Now, in this case, you can see that it came very close to that area of interest and it didn't break. It didn't go into that area of interest, that inefficiency. And then what happened here was it broke structure to the upside. And after it broke this structure, this is where it gets interesting. Now, if I'm skeptical that the trade will not work, what I'll do is I'll not be so eager to jump in. Right here, this was the first rally above the high, but it didn't break structure. There wasn't any significant candle closure. I'll zoom it in so you can see what I'm saying. If you zoom in here, you can see right here, the candle, there was a wick here, and I would personally prefer for the candle closure to be above this wicks. And this candle closed, but it didn't close above this wicks. So I don't regard this as a candle closure. Now, the next thing I did was I waited again, and then I saw this candle closed above. This was the break of structure. But after I saw this break of structure, I still did not buy. What did I do? I wanted to see multiple same time frame break of structure. Now, a lot of the information I'm giving you guys are what I give people on my one-on-one and group mentorships. But I'm just giving you everything for free so you all can go in, start trading, start making money. Now, what do I mean by multiple same time frame break of structure? This is a retest. Price came down in there, created another high, created another low. This low took liquidity from here. And after that, it broke structure. This is multiple same time frame break of structure. And this is the market showing me intention that it wants to go to the upside. Now, I'm no longer going to focus on waiting for this inefficiency to get mitigated. I'm going to focus on this move because now this is already showing me intention that market wants to go to the upside. The next thing I want to know is what is the draw on liquidity attracting it to this upside? What is that going to be? The first thing I can see here is this inefficiency. That's the very first thing I can see. I mark that out. The next thing I'll do is I'll go to a higher time frame to see if there's anything that could attract price to the upside. And then when I go to the weekly, I can see there's also an inefficiency resting right here. That now answers my question for the draw on liquidity. So all I'm now doing is I'll be going on intraday levels with what I've taught you guys that are in my program, and I'll use what I've taught you on using the 4-hour and the 1-hour inefficiency. I'm waiting for either 5 minutes or 15 minutes break of structure, and I'll be looking for short-term trades. 1:2, 1:3, I get out. 1:2, 1:3, get out. Don't try to hold any trade for too long. As much as this is the drawn liquidity, don't hold the trade until it hits this level. This is the mistake most traders make. You don't have to hold the trade until it hit this level. All you're doing is, this is the magnet attracting price. You're looking for low-hanging fruit objective. It could be 4-hour inefficiency or fair value gap, or 1 hour, or daily, right there. You can mark out those areas, mark them out, and use them as your key levels and wait inside those positions. Once price mitigates them, take your profit and go. Price came down in here, look for time frame break of structure. What time frame break of structure would you want to see? Can someone help me out?
The 4 hours,
30 minutes.
or like the 1 hour, 4 hours, 1 hour. I don't know.
30 minutes.
Yeah.
Call.
So since this is a 30 minutes, just go 3 time frames to the left. Don't overcomplicate it. 1, 2, 3. 30 minutes break of structure down here. Look for a buy, rally to the upside. Now, you can also use the Fibonacci. You can also use the Fibonacci to help you make things a lot smoother. You can also use the Fibonacci. And how can you use the Fibonacci? After price has come down here, and then you see there's a daily break of structure here. There's a daily break of structure here. Once you see this daily break of structure, you can draw your Fibonacci. This is how you draw your Fibonacci and use it to trade on intraday perspective. You draw your Fibonacci from the new range high to the new range low. The reason you're doing this is because you want to know where you are in whenever you're taking a trade, whether you are inside extreme discount or extreme premium, because you're anticipating for price to still come down here. Once you see prices at an extreme premium, you don't want to be in any buys anymore. You don't even want to be in any trade unless you're looking for a counter trend and you have to manage the risk. Now, in this case, you can see how price, after price rallied to the upside, retested on that extreme discount. Sorry, I wrote this premium instead of discounts. And this is the extreme premium. Now, after price mitigated this extreme discount, inefficiency, you wait for your time frame break of structure on the 30 minutes. You go to 30 minutes, you just want to see a 30 minutes break of structure. So let's see if this will let us go to 30 minutes. Now on 30 minutes time frame, you can see right there, that is the price action, and you can see how price came to the downside. Right here, it created a high, created a low, and this was a break of structure. It went down, it took that liquidity, this is not really a higher high, but this is the low. And then right here, this would have been your lower high, lower low. Then right here would have been your break of structure. Price went down again. Probably this would have liquidated your position, and then it broke structure again. Now, this is where a lot of traders lose a lot of money. When you're waiting because when you go to YouTube or you watch anybody's courses, they'll tell you this is a point of interest. For example, this is a fair value gap or imbalance. And they tell you when price comes into that fair value gap, wait for a break of structure and then getting on the retest, right? That's pretty much basic knowledge. Everyone here should know that. Wait for a retest. And now a lot of you will do that, and then you keep wondering why it's not working. You keep getting stopped out because price will do something like this. It will do something like this. It will run your stop, and then it will reverse, and then it go towards your direction. Now you're like, oh, it took my stop loss and it's still going towards my direction. That is what would have happened to you here. And if you also took the trade again, as this is the high, this is the low, break of structure, it would have happened to you again, twice, 2 times in a row. Most of you on this call will give up and you won't even bother to take the trade the 3rd time. Most traders will not take the trade the 3rd time. Now, this is what you can do that will help you to not be getting stopped out too many times. Wait for multiple same time frame break of structure. This is the area. This is the first break of structure. After you see price break this structure, wait for it to come down here, creating lower highs, lower lows, and then wait for it to break another 30 minutes structure. Coming down to retest, that's your entry. That's your entry. And if you don't see this second time frame break of structure, don't take the trade. Example, look at what happened right here. If you waited for this, you wouldn't have taken this loss because price after it broke structure, it came down. It didn't give you the second time frame break of structure. It took your stop. So you wouldn't have been in the trade. This would have been after that, this would have been your second lower high break right here. This would have been the second lower high. And right here, price rallied to the upside, broke that high. And then right here, it created this low, created this high, went straight down again, took liquidity again. So it was pretty much on the low, even though maybe you'll still be in the trade, but eventually it created this high and then it took your stop. So you still wouldn't have taken this second trade because you would have been waiting for this high to get broken for you to look for that trade. So 2 times the market would have wanted to hunt your stop. It wouldn't even have taken your stop. Now, this would have been your second area of interest. This would have been the high, this is the low, and this would have been the high that got broken. And after that high got broken, you don't need to rush in immediately and jump and take the trade. This is the break of structure. After that break of structure, created a low here, created a high, created a low. Now, all you want to see is for this high to get broken, then you buy. Once you see this high here break, once you see price break above this high, just put your entry on the high, use the low as your stop, add extra pips below, and that's your entry. And look at what happened right here. Right here would have been your entry. Right here, entry here, stop loss, this low, add extra pips below. This is 25 pips, add extra pips. Personally, I'll add 5 pips extra. The reason is because if you use this low as your stop loss and price came down here, as much as it didn't tap your stop loss, your broker might liquidate the position and get you out because they are looking for every possible reason to take you out. Give it some room. Extra 5 pips will not destroy your trade. And look what happened eventually. That trade rallied to the upside and delivered a 1:6. Just one setup. You don't even need to take 2, 3, 4, 5, 6, 7 trades. And you can target this inefficiency. You can target this green level, which is the fair value gap that we outlined previously. You can target that as your drawn liquidity or take profits. Once price hit that level, you take your profits and you leave. You bought, look at what you did. You literally bought from extreme discounts. The moment price is hitting equilibrium, you need to be leaving the trade. If this is a day trade or if you're just trading within, let's say you're an intraday trader or you hold within the week, equilibrium, just take the profit and leave. And that equilibrium, look at the equilibrium. This is still 1:5. If you targeted this inefficiency here, it's still 1:4. Any one of them that you use, you would have made some really good profit. If you're trading 100K from that account, that's 4 grand on 1%. 4 grand is, I don't know, unless you're a manager at a company, no one is paying you 4 grand a month unless you're a manager at the company. If you're not, you're going to be getting paid 2 grand, 3 grand or less. But you're making this on just one setup, not 2, not 3, one setup. And you can compound this profit if you have more than one account. I don't know if this is making sense, everyone.
Yeah, it is.
Yes.
So this is basically how you can use the Fibonacci, market structure, inefficiency, the 3. You don't even need anything else. You can add something else if you want. It's entirely up to you. But me personally, I would highly recommend you try to keep your trading as simple as possible. The simpler you keep it, the better for you. The more complicated you make it, the more confused you'll be along the line. Because sometimes when the market goes against you, you're gonna start blaming one thing or the other. You can start blaming, oh yeah, it's because I used my indicator, that's why it didn't work. Oh, because I used the EMA, or because I used this or that. I'm not saying those things are not good. Like if you started here, I literally said all those indicators, a lot of them do work. You just need to understand your market structure, what is the draw on liquidity, where is price going, and you will see that the indicator will work for you. In fact, let's also have an example using the MACD. Now, I'm not recommending the MACD to anybody. I'm not saying go trade with the indicator. I'm absolutely not saying that. But I'm just trying to give you an example that these indicators actually do work. And you'll be surprised to see that. Now, in this case, we're bullish. What are we looking for? The only thing I'm looking for right here is I'm looking for this red to be full. And then I'm looking for that cross here. The moment I see this cross, I'm looking for a buy. I'm using the most recent low as my stop loss. Now look at this price action. When it crossed, what happened? Spike up. So this would have been my entry, and here would have been my stop loss. Is that making sense, guys?
Yeah.
And it still would have worked out, even with an indicator. I'm trying to show you that what is stopping you from being consistently profitable is not the strategy. It is your understanding, your foundation. If you haven't built the right foundation, nothing will work for you. If you like, go and do 1 year mentorship, 10 years mentorship, anywhere, it still won't work. The foundation needs to be built right. So this is how you use the Fibonacci on the intraday levels to trade within the day, within the week. Let me show an example on how you can day trade with the Fibonacci. So this is a typical example of a trade I took last week. All you got to do is mark your higher highs and your higher lows. I'll just delete everything on this screen. Show you the example. Right here, if you mark your higher highs and your higher lows, this is your higher low, and then this is your higher high, this is your higher low, and this is your higher high, and this is your higher low, and the higher high. Excuse me, and this is your higher low, and then this is a higher high. Now, this was the trade I took. This is my higher low, higher high. I marked out my inefficiencies, and I could see there was multiple inefficiencies here, 4 hour, and there's another one down here as well. And then I use my Fibonacci from the low to the high, and right here, and I could see that this is my extreme discount level, and there's an inefficiency there, and I saw price come down in there. That's already giving me a high probability opportunity for price to reverse from here. And remember, the first thing you need to do is to derive your drawn liquidity. What is going to be the magnets that attract price to whatever location you want it to go to, whether it's to the upside or to the downside. In this case, it is to the upside. So I'm anticipating for this inefficiency to attract price to the upside. So I'm looking for key levels where I can buy into that inefficiency on the monthly, because the monthly inefficiency is actually a big time frame that will attract price to the upside. And right there, but the moment I see price coming in here, mitigating it, I just go straight down to the lower time frame. So what time frame break of structure would you like to see? Can someone help me? 15 minutes.
15 minutes.
Exactly, 15 minutes time frame. So all I want to see is a 15 minutes time frame break of structure. And then I'm looking for trade opportunities from that zone. And right here, price came to the downside and it broke structure here. It came, mitigated that position, and it broke a 15 minutes high right here. And after I broke this 15 minutes high, I don't even have to jump in immediately. I can wait for same time frame break of structure. Because the reason I wouldn't even want to jump in is because my stop loss will be too wide. And I don't want to have like 70 pips stop loss. It will take forever for the trade to hit my stake profit. Now, in this case, this is merely a 35 pip stop loss, but it's still too wide for if you're trading USD card, because it's a very slow pair. It's not volatile. 33 pips is a lot for USD card. So all I did was wait for multiple same time frame break of structure. And right here, you can see how price came, created a high, created a low, created a high, created a low, broke structure. And the moment it broke structure, this area becomes my entry position. And look at how price came there twice. and give an entry right there. This is how you use it for intraday trading. Stop loss this low, 11 pips. Add a few extra pips below. I personally prefer adding between 5 pips. And right there is a 1:4 risk to reward ratio. Beautiful trade. If you're risking 1%, that's 4 grand on a 100K account. Just one trade. We're not talking about you taking 3, 4, 5, 6 trades or over leveraging. Is it making sense, everyone?
Yeah. So, USD CAD being a slow pair is best for swings mostly, right?
You can still trade it for both day trading, swing trading. It just depends on the point of interest you're using for your trade. If your point of interest is on the higher time frame, yeah, you can do a swing trade. If it's your point of interest is on the lower time frame, it's best to day trade. Don't try to hold it for too long. Depending on also whether you're counter trending or pro trend. If you're trading with the trend, yes, you can hold the trade a lot longer. But if you're trading against the trend, I would highly recommend just target 1:2 and get out because price can easily
Okay.
reverse to you. For example, this trade is a counter trend. I'm trading against the trend. The trend is bearish. Long-term perspective, the trend is bearish. Why is the trend bearish? Why did I say it's bearish? Same thing. Market structure. Go straight down to 12-month time frame. I'm gonna have to use a different chart for this. Now, always remember, guys, whenever you're doing analysis on the long-term perspective, always remember to use FXCM. Always remember. I've had this question so many times, endlessly. Always remember to use FXCM for your long-term analysis. They have the longest data. Most of these other brokers are very relatively new. Some of them, you can see this one, their data started in 2007. And then this one, their data started in, this one, they started in 2016. You can imagine. So FXCM is the only one that has the oldest data. And right here, this is FXCM. And you can see they started in 1971. And this is the perfect one. And the reason why you need to use this chart is because it's showing you the complete data that you need to know which direction the market is going. And you can see that when you look at it and you look at the other ones, they are different. How do you know which direction is a long-term trend using this? You don't. It's not rocket science. How do you know? You can't. You can't figure it out with this. You can't. You can try, but everything you're going to be doing is just guessing. But when you're using this, there's no need to guess anymore. You're looking at the price action, you're looking at the market structure, and everything is literally very clean cut, showing you we were previously creating higher highs, higher lows, which means we were bullish until we dropped from here and we went straight down to the downside and we broke structure significantly. After breaking this structure, all we just do is we can use our Fibonacci from the high to the low. Because this break of structure here is already showing us intention that the market does not want to keep going to the upside in the long-term perspective. All it wants to do now is to run liquidity, continuation to the downside. I literally just give you all the blueprints. So you don't even need to be wondering what direction is it going. This blueprint I've given you will last you for years. If you watch those videos I talked about on DXY almost 3 years ago, that's a blueprint to show you which direction to be trading for DXY Euro. And right here, this is the run on liquidity. The moment you see this run on liquidity, what time frame break of structure do you want to see before you now start selling? This is
Daily.
12 months. Daily, exactly. All you want to see from here is a daily break of structure to the downside. Once you see that daily BOS, you focus on long-term sales. And right here is a daily low, daily high, daily break. Came back, retest, and we've been in a downtrend. Everything here is low resistance. You can come back to this video. It's recorded, so I'll post it. I'll try and post it on YouTube as well, just in case if you, for whatever reason in the future, you want to come back to the video to see whether anything I talked about came to pass. I'm giving you the blueprints. This is my area of interest. Price coming up here, if I see a significant break of structure on the daily from here, that is a shift in market structure, mega trade. We will go on a massive downtrend to run out all these lows because everything here is low resistance, low resistance, low resistance, triple bottom, supports, all the rest of them, trend lines. I'm not saying they don't work. I said it previously. They all do work, but don't forget they are also used to engineer liquidity. Here, if you're trading all this double bottom, triple bottom trend line, it would have worked for you. You could have gotten into a buy. So, is it making sense, everyone? Does anyone have any questions?
Yeah, it's making sense.
Can you also see how we mitigated the extreme premium level? And after that, we displaced to the downside. Can everyone see that?
Yep.
That is to show you how powerful the Fibonacci is. Now, what makes the Fibonacci powerful? It's not because it's Fibonacci. What makes it powerful is the numbers. The algorithm moves with numbers. That's what the algorithm is targeting. It's not targeting your support line, your resistance line, your trend line, and all the rest of them. There's a number there that the algorithm is targeting. We don't know what that number is. We are only using, this is mathematical. We're only using the Fibonacci to derive when the market is at overbought or extended, too expensive. So we can now start looking for confluences, signals that the market wants to now reverse and start going to a different direction. That's all we're using this to do. Don't overcomplicate it and think that the Fibonacci is just the holy grail. Using it, all your problems are solved. It's only a very tiny fraction of what you need to know. You're just using it as a confluence to align with your market structure and your inefficiency. You can see that price reversing from this key level, it wasn't just because of the Fibonacci level. There was already an inefficiency here, and there was also low resistance liquidities here. So the market came for liquidity, mitigated an inefficiency, took liquidity, and then used here as an extreme level because it's already at an expensive price. And then we saw that reversal. So that will be all from me. Unless you have any questions, if you do have any questions, now would be the perfect time for you to ask your questions. If no questions, then I think that will be all from me. If you do need,
I had a question.
yeah, ask a question.
There's this the way you mark fair value gap, and maybe for the one that you're showing 15 minutes, then you say wait for another 15 minutes. So how long does that should I say systematic break of structures should happen so that for how long does it have to happen so that you can invalidate whatever happened? Like if I would say there's a let me if there's a break of structure here, right?
Where?
Then
Mark it again, sorry.
let's say here. Not sure if you is it clear?
There's a break of
Can you
structure.
see it? Yeah, like yeah, there. So, and you say that we can wait for another break of structure. So let's say maybe it happened at another place here. So I want to know what needs to happen for these to be invalidated and maybe look for another break of structure. Like how long does the break of structure last as a break of structure so that we move around and look for another break of structure? Don't know if my question makes sense.
So I think I kind of understand your question in a way. You're trying to figure out
Yeah.
how long you need to wait to say it's now invalidated and it won't
Yeah.
go,
Or
right? Is that correct, right?
yeah. Yeah.
Cool.
Yeah.
One thing you have to bear in mind is the market robs the impatience and pays the patience. So if you actually want to make money in this market, you need to be extremely patient. That is why sometimes me and you will have a chat and then I'll tell you, no, I've not actually taken a trade this week because I'm waiting for the best opportunity. Now, using this as an example, we're on the 16-hour though. So now this is a break of structure, right? After this break, now let's say you're still skeptical about this trade and you don't know whether it will go up or down. Now, This is the structure. Lower high, lower low, lower high, lower low, lower high, lower low. And boom, a break of structure right here. Isn't this a break of structure? And after that break of structure, what happened? They came back and they retested. And after they retested, what happened? It rallied to the upside. It gave you the second same time frame break of structure. You can go and backtest this. I'm not giving you anything. I'm telling you, oh yeah, trust me, bro. Don't do it. Don't I'm, I'm not one of those people who tell you, trust me, bro. There's no trust me, bro, here. Go and backtest everything I'm saying on the chart on your own and figure out if it will work for you. And you will see how this works. You will see that it's literally working on every single time frame. This example, it was your idea, votes. I didn't even use this as an example.
Yeah.
And you can see how it still worked out. Same area, same time frame break of structure. And this is 16 hour. Look at this. This is another example here. This is low, this is high, this is break of structure. And after this break of structure, let's say you're still bullish because this market has been trending to the upside and you're still bullish. You still expect it to go higher, but you're skeptical about selling it. Look at what price did. After this break of structure, it started trending to the upside, creating higher highs, higher low, higher high, higher low, higher high. And it broke another structure. And let's say you're still skeptical. You're like, maybe this will work, maybe it will not work. It created a high and then a low, created a high, and it broke another structure. Still came back up for a retest. So it literally gave you 3 breaks of structures. This is the first one, this is the second one, this is the third one. So even if you were skeptical for the first one, break here, you didn't want to sell from maybe this inefficiency, it gave you the second one. Maybe you didn't want to sell again because you're still skeptical. It gave you the third one. Now, if you miss this one, you're a dummy. I'm sorry, part of my language. But if you miss this one, then just forget about it. 3.
Okay, still on the same. What will you advise for, okay, being skeptical on that, being skeptical on a trade? When you have this knowledge that, this is maybe low resistance, right?
Yep.
So you are like hoping that maybe it will come, take resistance. So because you have this knowledge, you end up, it's not bad knowledge to have, but you end up missing this trade because you are expecting for this liquidity to be taken. How can you advise to deal with such scenario?
What you can do is literally what I just showed you here. Wait for another BOS. Wait for that same time frame BOS. If you see that same time frame BOS again, that's the market showing you signal that it wants to go towards that direction, and you should stop focusing too much on this because
Okay.
sometimes we traders, we go into this learning curve
Paralysis.
where we are learning and learning and learning, and then we learn everything and we are now like paralyzed. We don't even know how to react. You're now trying to take a trade and you're now looking at, oh, there's an inefficiency, a fair value gap here, there. I'll show you an example. Now, this was an example on a trade. I was talking to this guy. He's in my one-on-one mentorship, and we were talking about this. It was on Bitcoin, a trade on Bitcoin. And Bitcoin came down here. When it came down here, 107, and he was like that he wants price to come down to this inefficiency down here. That's where he wants to buy. And then he marked this area out. And I was like, yeah, you're not wrong for you wanting price to come down here. But there's no guarantee price will come down here. Like, look at how many inefficiencies we have. We have this one here. What makes you think that this one is not enough? Price can decide to mitigate here and continue higher. And if you use your Fibonacci from this overall low to this overall high here, your goal is to look for buys inside discounts. Look for inefficiencies below equilibrium. Your goal is not to predict the low or the high or where the market will top out or where the market will bottom out. That is not your job. Forget about it. If you're trying to always predict, oh, I want to predict the top, the bottom, you're just wasting your time, unfortunately. because you a lot of the times you get disappointed. You don't need to predict the exact low, the exact high. Just wait for a break of structure. And look what happened here. Price came down here and it broke this daily high. After it broke this daily high, I told him, forget about this fair value gap you're seeing down here. The market is already showing you intention here that it wants to rally. So wait for a retest and buy. Okay, let's say you're still skeptical. Look what happened here.
This happened to me.
What happened to you?
Yeah.
So, and even another of my guy, he took a sell from this inefficiency here. He took a sell, and then the sell came down here, and he made money, and he was telling me about it. And I told him, "Have you closed the trade?" He said, "Yeah, yeah, yeah." I told him, "Don't sell it again. Don't even sell again. We are inside discount. Selling here, you will lose what you've made." And look what happened. Price rallied. And look what happened here. It created a high, a low, it broke structure. Same time frame break of structure, retested and rallied. I'm not showing you this with one example to tell you, oh, it works here, it doesn't work here. It works on every single pair. I said this yesterday. You can use the strategy, you can trade soybean, you can trade sugar, you can trade futures. I have people in my program, we don't even trade the same thing. They trade stocks, they trade options. I don't even trade options anymore. But they are using this same knowledge and they are trading it and they are profitable traders and they are making money. And we review their trades.
Which pair is options, sir?
Op So options is like so you can trade Amazon on options. You can buy call options. You can buy like to sell or to buy. Just the same way you buy euro and sell euro. You can buy
Okay.
call options, puts to sell. If Amazon is going down, you can basically use that puts to sell. So if Amazon is going down, you're making money. If it's going up, you're making money. You buy call options. So eventually, some of you
Yes,
will venture into it. Some of you might be interested in it. A lot of people that live in America, they always like to trade options. And it's still interesting in a way. It has its pros and cons. Example, you can see that Bitcoin coming down here. This is discount. You can buy a call option for Bitcoin to go up. Now, you're not really stressed out about stop loss. The only thing you're stressed about is depending on the time frame of that options you bought because you need it to go towards that direction. So it's a little bit complicated. You're gonna need to take like a course to understand some of them. Don't just jump in and start buying something you don't understand. But my point is technical analysis is technical analysis. It's literally the same no matter what you're trading, whether you're trading Forex, crypto, commodities, or you're trading whatever it is you're trading, it always works the same way. It's all about understanding the market structure, the inefficiencies, and then using the Fibonacci as the source. So this is just an example. Let's look at the stock market as example. So this is Amazon. So if you look at Amazon here, this is 3-month time frame on Amazon. Now you can see that looking at this structure, this is the low. Let's just go to monthly so you can see this chart a little bit cleaner. So you can see this is your low, this is your high. And if you use your Fibonacci from this overall low to this overall high, look at what happened. Price came down here into an extreme discount, accumulated, and rallied to the new all-time high. So you can basically see that it's literally the same process. You're using the same exact process. So for now, me, I'm more interested in just investing in stock market. I don't want to just overcomplicate things for myself by doing too much because I feel like I can do it all. You just have to pick one aspect of this that you like and you want to focus on. If you want to trade cryptos, you can focus only on crypto trading. If you want to trade Forex, you can focus only on Forex trading. Now, what you can do is you can diversify your portfolio. You can have crypto trading, and then you can do investing on stock markets long term or investing on whatever else. But when you're actively trading, try and trade one specific market. Don't try to trade everything because that's how you blow your account. As much as we're not robots, we're human beings, and everyone here has their own personal life to deal with. Maybe parents, family, wife, children. A lot of all those things will always play a part in your psychology. And before you know it, you now feel like you're overloading yourself. It's just like thinking you can do five different jobs the same time, like working for five different companies the same time. Maybe you can do it, but if you do it for a very long time, you're gonna get taken to the hospital eventually because you're gonna crash down. But that's just my opinion.
I, I had I had a question on using the Fibonacci in areas where swing lows and swing highs like are not very clear. Let's say in a market, let me use for example, let's say gold. Like if we have a scenario where it's like the way it is at the moment, like do we like not now consider uh Fibonacci when using it, or like in such a thing? Like I'm like, what is this?
Yeah. So now in cases like this, what you can do in cases like this is you can still use the Fibonacci in some cases. Now, let's just mark this out. Now, this is your range low. Now, bear in mind that it's not mandatory every single time that price will come into a discount. Sometimes it's not going to come into a discount. Sometimes it will. Now, what will help you is, let's say it mitigates an inefficiency and then it's not inside a discount. You can just wait for multiple time frame break of structure before you take the trade. So this is just an example from this low to this high. If you use your Fibonacci right here, this is your low, this is your high. You can see in this case, it came to discount, it rallied to the upside. Then in this case, this is your low and this is your high. In this case, it didn't come to your discount and then it rallied. So what you can do in this scenario is, this is the scenario where you mark your point of interest. Let's say your point of interest is an inefficiency. So this is 4 hour. We'll go to daily. We want to see what that inefficiency looks like. On daily, there's a fair value gap there. You mark it out. And you can wait inside there and you can say, okay, I'll wait for multiple break of structure, maybe on 15 minutes or on 30 minutes. So let's see what that looks like. So I'll take this bar replay down here. Now you can see price is down there and it's not inside your discounts. And we created a high, created a low, created this high, created a low, and then we eventually broke structure. And after we broke that structure, you don't have to jump in immediately. You can just wait. You can see it retested and it rallied. You probably might have missed the trade. You can just wait for, let's see on 1 hour time frame what that looks like. So this is quite a very choppy price action. So what I do when the price action is choppy like this, I try to scale up time frame to use a higher time frame break of structure. For example, if you use a 1 hour break, you can see that the price action looks a lot cleaner on the 1 hour. If you use 30 minutes, there's so much going on here. There's so much going on and all this spike up. So me personally, I'll prefer to use that 1 hour break of structure. And the reason is because I can see a very clear lower high, lower low, and then a very clear break of structure. Now I have a clear price action I'm working with. Now I see a break of structure. I'm not going to jump in. I'll wait to see another 1 hour break of structure. And right here is another lower high, lower low, lower high, and then this lower low right here. and then eventually we have this break of structure. Now, in this case, you can see that after price broke this structure, I doubt it's going to retest. So bear in mind, sometimes you might be a little bit aggressive, which is market execute. The moment you see that candle closure coming down here, you just market execute that position, and your stop loss will be this overall low. You can market execute from here, target your 1:2. This is the break of structure, candle close. The moment you see that candle closing, you can now take your trade. So it's not really far away from the high, so it's not a bad trade. It's not the best, but your target is just that 1:2. And if you're able to get that 1:2, you get it, you get out and leave the market to do.
My observation after like backtesting this, it's like gold tries to hide break of structures, and when now it rallies, it just escapes.
Now, can you see what happened here? Even that 1 hour high, it's eventually retested on that 1 hour high. Can you see that?
Yeah.
It's actually retested. So even if you were even patient and it broke that structure and you just put your entry on that 1 hour high, it still would have activated you anyway. So, but sometimes it won't activate you. So just bear that in mind. So now everything is all about percentages, so averages. You're looking for your best case scenario, worst case scenario, medium case scenario. If you're using after a break of structure, you want to see a retest. Bear in mind that price will retest between 50 to 70% of the time, and the remaining 30%, 40%, you'll miss the trade. So if you want to be in every single trade, that means your goal will be once you see that break of structure, candle closure, you just market execute. Use the overall low as your stop. Now, I don't trade like that, to be completely honest with you. The reason is because my personality, I'm just very relaxed. That's just how my personality is. So I don't like market execution. The reason is because of brokers. When you market execute, they push your price even higher than the entry where you market executed. So that's why I don't like using market execution. I prefer to just use buy limit.
Happens a lot, honestly.
Yeah. So that's why I don't do it.
Happens a lot.
But everyone is going to be different. I always say this in my programs. Every single person that has gone through my program will trade differently. Like,
So, do you mean market execution? Do you mean at current market price?
yep.
Okay.
That's what I mean. So I always say this, everyone that has been in my program will trade differently. You all are not going to trade the same. For example, John has been in my program, Vote has been in my program, but they both trade differently, but they have the same understanding of market structure, but the way they trade are different. John will send me a trade, the same pair, his entry is different, and Vote will send me a trade, the same pair, and his entry is different. His take profit is different, but they are trading the same direction. So don't think because this person is doing this, you have to copy that person. Everyone's journey is different. How you trade would depend on your personality. So that's pretty much it from me today. And I appreciate every single one of you who tuned in for the live sessions from the very first one. I appreciate you, Votes. You were the most consistent. You tuned in for the 3 days and you always show up. Even when we do group sessions, you always show up. And this is how you know someone that will win eventually. I was watching a video, it was by Alex Omozi, when he was doing group sessions with some guys, and every single session he did, there was a guy, I can't remember the guy's name. The guy was on every single session, and he was like, dude, in 6 months time, or in 6 months, I hope you come back a millionaire. And the guy made a million before 6 months, the guy made a million in his business. And that is to show you consistency. Anyone who is consistent will always win. It is inevitable. You will win. You have setbacks, but you will win.
Always.
Yeah, so Bobo as well, you showed up the entire time, and John showed up as well. That is showing consistency. Just keep being consistent. Go through the videos, go through everything. every single resource that I've given you guys. Go through them. If you have any questions, drop it in the group chat. If you enjoyed this session today, please drop your comments in the group chat, HCS HQ. Drop it in there.
So, when are you going to teach us how to calculate pips?
How to calculate pips. Yes. So I was meant to make a video on that.
Yes.
I was just caught up with so many things this weekend. Yeah, I was meant to drop a video on that, but I've just been very busy this weekend. But I'll drop an announcement, something about something I'm working on, and I will teach that in the stuff I'm working on. But if I don't drop the video, I'll drop a link where you will get the video. But one of the two, you'll get it this week. Unfailing, I promise. But yeah, to be honest,
Okay.
how to calculate pips is literally like the simplest things you can do, to be completely honest with you. But I'll show you how you can do that. You can use Cashback Forex to calculate pips. There are other ways you can also do it as well. But yeah, don't worry, I'll give you a feedback very soon. I'll give you a feedback on that. So, the last thing I wanted to say is if you enjoyed the session, I would happily appreciate it if you leave your comments in the HCS HQ. If you enjoyed the mentorship session, the 3 sessions, or you watched the recording and it was amazing, I need your comment there, please. And if you have any recommendation, anything you want me to add in any other session we do, feel free to drop it there as well. I would appreciate that. And so if you guys are also interested and if you want me to open up my VIP mentorship session again, let me know as well. You can send me a direct DM. You can also message on the chat. If you're interested in the one-on-one, anyone it is, just text me and we all go from there. But finally, I appreciate you all for tuning in. And I'm always here to guide and support you guys. A lot of guys here went from blowing account to knowing what they're doing, like Votes, like John. Before John met me, he was blowing like his account back to back. If he was doing a fundraiser for his broker. So, but now literally trading
Not anymore.
on his own and making his own money gradually, and Volts doing the same. And a lot of other guys, a lot of them don't even tune into my group sessions because they're on the one-on-one. So they basically don't care that much about the group sessions. So,
Yep.
but what gives me the most happiness is being able to impact people's lives and help them in their journey from blowing accounts, losing money, to now making money and making withdrawals. That's what gives me the most pleasure. And I want to see every one of you here win. And I already know some of you that will win massively. So many of you that I can already see that will win. And as long as you keep the pressure, keep following the system. The challenge a lot of traders face is when it starts working, they lose control and they just go and blow their accounts. They feel like, oh yeah, the strategy works. They forget about all the risk management parameters I taught them and they blow their accounts. Don't do it. Like there's a guy in my one-on-one. The guy went on a 7% drawdown on his account. He made a mistake. So his broker, they basically changed the contract size. And he didn't know they changed the contract size on the pair he was trading. And after he calculated the risk, he used the risk from Cashback Forex, put it there, and he didn't know it was literally 10x the risk. And the account almost, he literally lost 7% in that trade. And when we had a call, because he's telling my one-on-one, and I told him, relax. In fact, this is a test. If you can bring this account back from this 7% drawdown, that shows you that you've learned this stuff. It was like, yep, all right, I'm up for the test. Do you know how much it was risking? 0.3%. In fact, I'll tell you who this guy is. God's time. Some of you have met him.
Yeah. Yeah.
0.3%. That's what he was risking. And he used 0.3% to bring the account from 7% drawdown back to break even and in profits. And withdrawal. 0.3%. He wasn't over leveraging. He wasn't risking 1%. He was risking as low as possible. The reason I'm telling you this is because every one of you can do the same thing and so much more. And the reason why he's a phenomenal trader is because he's patient. He's taking his time. He's not in a rush. The market pays the patient and it robs the impatient. The moment you tell yourself, oh, I need to pay my rent, I'm going to trade that rent out of the market, you blow your account. So
Done that, man.
That's true.
So that's it from me, guys. I'll see you all next time. Anything at all, any questions, just feel